This is John Lothian for The Spread with John's Take. This week, comedian and TV star Jon Stewart shined a big bright light on the subject of payment for order flow in equities trading on an episode of his show, The Problem with Jon Stewart. While his take is always entertaining and sometimes impactful, I wanted to share with you another source that has also looked at the subject. Hitesh Mittal and Kathryn Berkow of BestEx Research released a paper last year titled The Good, the Bad, and the Ugly of Payment for Order Flow that looked at the impact of the practice on institutional investors. The paper was in response to payment for order flow becoming topical again after the GameStop Gate controversy that saw Robinhood and other firms restrict investors' ability to buy shares of this then widely volatile company. I interviewed Hitesh over Zoom this week and asked him about his firm, why he and Kathryn wrote the paper, what surprised them, the impact of payment for order flow on institutional players, the impact of payment for order flow on retail traders, interesting statistics they found, and if anyone paid them to do the research. The first question I asked was who he is and what his firm does. I wanted to see what experience he brought to the project. He brought a lot, including building ITG's algorithmic trading products globally, working there for 10 years. Then he joined hedge fund AQR as head of trading and built their internal execution algos.
I started BestEx Research 4 years ago. BestEx Research provides algorithmic execution for equities and global futures. And I've personally been doing this for 20 years. I built ITG's algorithmic trading product globally, and I worked there for 10 years. And then I joined a hedge fund, AQR Capital, and I was the global head of trading there and built their internal execution algorithms. And kind of saw that the industry algorithms, mostly big banks, the products are pretty mediocre and leads to very high transaction costs, and felt like there's an opportunity to build an algorithmic execution firm that's a pure play firm and focuses just on minimizing transaction costs and building the best of the breed execution algorithms. We are a FINRA registered broker-dealer. We are an agency broker for trading equities. For futures, we are registered with NFA. We are an introducing broker. And we compete with big banks as well as other agency brokers in providing execution algorithms, but that's the only thing we do. We also offer execution algorithms in a software as a service format, wherein the big banks and brokers can white label our platform and offer it to their clients. And to provide that service, we offer a platform called Algo Management System, which basically allows them to service their clients so they can actually customize execution algorithms differently for different clients, and they can run their transaction cost analysis, build custom reports, they can monitor algos, they can modify parameters in real time and things like that. So all the things that you basically need to build an algo trading business, we provide that in one box in a cloud-based solution. So we serve buy-side clients, hedge funds and asset managers. They can use us directly because we're a broker-dealer. But we also serve sell-side firms who don't want to invest tens of millions of dollars in building their own algo product, can basically use our products as well.
My next question was, why did he and Kathryn research this subject?
Part of our job is to really understand market microstructure because we want to minimize transaction costs for institutional asset managers, and we want to understand how the current market structure is working and all the idiosyncrasies around that. And one of the things, obviously, that everyone is noticing is the increase in off-exchange activity, right? And off-exchange activity is not just coming from like traditional dark pools, which are registered as ATSs. That only represents about 10% of the overall equity volume, but there's almost like about 45% of the overall equity volume if you exclude the opening auction and the closing auction that is happening, with wholesalers. And there's only a couple of few wholesalers that sort of dominate that market. who are buying retail order flow. So we wanted to see what is the impact of that market structure on different types of investors, retail investors, as well as institutional investors. So that was sort of the main impetus behind this research study.
I asked him what his expectations were from the research.
My expectation was that we would probably find out that all of this order flow that is going to wholesalers and not going to exchanges, it benefits the retail investor, but it hurts the institutional investor. That was what we like to call our prior before doing the research. But what we found was that this market structure, it obviously definitely hurts institutional investors, but it also hurts the retail investors, which is not sort of the common wisdom, which is what sort of really surprised us, from the findings of this research. That's what surprised us the most.
I also asked him about the impact of payment for order flow practices on the market performance of institutional players.
Institutional investors, it hurts because institutional investors are trading mostly in exchanges, right? So a big asset manager, they're trading in these execution algorithms, which are accessing liquidity in ATSs, dark pools, but also in exchanges, right? And when they're trading in exchanges, they can trade in two ways. They can be a liquidity provider, they can try to buy the bid or below the bid. So they can be passive in the exchanges, or they can be crossing the spread and they can be sending market orders, right? And so if you think about any execution algorithms, they're made up of two types of orders, passive orders and aggressive orders. And for both of those types of orders, when they're sending these orders to the exchanges, they're getting hurt by the fact that exchanges are not attracting retail order flow. So when they're providing liquidity passively, they're getting hurt because the retail investors are relatively less informed, so they're less toxic. So if you're buying at the bid in an exchange, you are very likely to get picked off in that after you get when the prices are going up, you're not getting your executions when you're providing liquidity passively, and when the price is about to go down, you get your execution. So you have this regret, why did I get that execution, right? So you get picked off or you get adversely selected. And how much you get adversely selected, that really depends on how toxic, like we like to say, how toxic is the flow that is going to these exchanges. And retail flow is the least toxic flow, and that does not make its way to the exchanges because that flow is sitting with the wholesalers. They intercept that flow even before it just doesn't ever make its way to the exchanges. And so as a result, when the institutional investors or other market makers, when they're providing liquidity in exchanges, they get picked off by a lot when they're trading passively, right? And if you think about it from a liquidity provider's perspective, right? If you think about the bid-offer spread that is in the exchanges, that is, directly a function of what is the cost of providing liquidity. And the cost of providing liquidity is how much do you get picked off. So if you're getting picked off a lot, the bid-offer spread basically goes higher, right? And institutional investors are also taking liquidity a lot of the times, and they have to pay this bid-offer spread. So either way, they don't win. When they're providing liquidity, they're getting picked off a lot more. And when they're taking liquidity, they're paying much higher bid-offer spread than they would if this retail flow had made its way to the exchanges.
I followed up with a question about the impact of payment for order flow practice on the market performance of retail players.
That's a little bit more complicated story there, right? So retail investors, they actually do better than what they would if you just think of it like as a standstill, that, okay, here's the exchange and here's the bid-offer spread, right? And if a retail investor is sending a market order, are they getting a better price than what they could get if they send that order to an exchange? The answer is yes, right? They're getting a better price than what they would get if they sent that order to the exchange, if it is a market order. I just want to qualify that, right? And on average, they get prices that are 15% better than what would be available, not the prices, the bid-offer spread that they get is 15% better than what they would get at an exchange, because wholesalers are able to cut them a deal that, your flow is not toxic, so we'll give you a narrow bid-offer spread, right? So from that perspective, it looks like retail investors are doing pretty good, right? But then you also have to take into account, hey, what will happen if this retail flow actually moves to the exchanges, right? So this argument that I just made, right, which is the argument that all the wholesalers make and all the retail brokers make, because they're sending their flow to wholesalers and getting payment for order flow, that's how that argument goes. But that argument ignores the fact that if the retail flow actually moves to exchanges, the bid-offer spreads are not going to be what they are, right? And going back to what I said earlier, bid-offer spread on exchanges, it basically is directly a function of cost of providing liquidity. And if the retail flow moves to exchanges, the average toxicity of the flow that is on exchanges is obviously going to go down, right? And the average toxicity of the flow will go down by a lot, because outside of the closing auction and opening auction, retail flow is roughly 45% of the total volume that is out there, right? So you've got this bad flow and you mix a good flow, right? You get some sort of an average, right? So we basically did the study to figure out, okay, how much the bid-offer spread will go down if all the retail flow moves to the exchanges. And the answer is 25% of the current bid-offer spread. So retail investors today, they get 15% better spread than what is available on the exchanges. But if that flow made its way to the exchanges, because of their own liquidity, the bid-offer spreads are actually going to go down by 25%, which is a better outcome for retail investors than what it is, than what they're getting today, right? So it's going to be good for institutional investor as well as it's going to be good for retail investor if that flow made its way to the exchanges.
I asked Hitesh if there were any interesting statistics that came from the report.
Yeah, the statistics was basically this. This was the most important statistic that often, everyone is measuring their performance versus what is the current bid-offer spread on the exchanges. And everyone knows that bid-offer spreads will actually go down if the flow made its way to the exchanges. Some people like to ignore that completely, but people know that the bid-offer spreads will go down. But the question is by how much, right? And we basically quantified that, and we quantified that by comparing what is the average adverse selection, and we compute that in our paper. What is the average adverse selection when retail is trading with the wholesalers, and what is the average adverse selection when the rest of the flow made its way to the exchanges? And what is the relationship between this adverse selection cost and bid-offer spread cost? So using these two facts, we were able to determine what will be the exact sort of bid-offer spread reduction if the retail flow moved to the exchanges. So I would say that was the most important statistic.
I asked Hitesh what was the response to the BestEx payment for order flow report.
Obviously, the folks who are wholesalers, and they obviously don't love it, right? They have a business model to protect, and I completely understand it. So that's sort of one side of it. But I think on the other hand, regulators and folks, institutional investors, this is the first study that has come out really that quantifies what is the impact of this wholesale market structure or retail market structure, whatever you want to call it, on the overall execution quality of the market, right? So it really depends on what camp are you in? Do you really care about the overall quality of the markets and market structure and costs to the investors? This is one of the first papers that quantifies that, but obviously it's sort of, from a wholesaler's perspective, there's not much to like about our findings.
My last question was whether anyone paid him to conduct this research. I wanted to make sure this was not a candy bar study conducted in Hershey, Pennsylvania. No, this was on our own dime. That's true for everything we've written. We've written a number of research papers. We want to provide the thought leadership, and we want to bring the truth to the market. So none of our papers are sponsored by any party. They're all independent research pieces. I was not surprised by the results Hitesh and Kathryn found. What was great about it was their ability to put quantitative numbers behind the impact of retail volume being removed from the exchanges. Perhaps it is time to find a way to get all the market participants back into the same pool again to be able to interact. Any one investor's ability to trade with any other investor, big or small, has been a big part of the success of electronic futures trading. Maybe the SEC should find a way for equities to give it a try. This is John Lothian. Goodbye.